Okay, I want to touch on two concepts today that a lot of people ask about, and I want to really kind of dive into them because they're important concepts. The first one is called the whipsaw, and the second one is called the juice. Now, they're both kind of related, but I'm going to start with the juice. So what is the juice? What do I talk about? Well, a lot of people say, man, you say juice a lot. Well, I'd rather say juice than extrinsic value. I'd rather say juice than time value. I'd rather say juice than out of the money amount. Juice just sounds better. Plus, it's more fun. So the juice is what we're trading for. That's what you got to focus on. That's the option premium plus the in the money amount. So when you look at an option premium, it's made up of two things, the in the money amount and the out of the money amount. That's it, right? So if I'm doing in the money covered calls, which I do a lot, and I really believe in the philosophy of being in the money most of the time, well, I have an in the money amount plus I have the juice, right? The out of the money amount is the extrinsic value. The juice is what I'm after. That's my income. The juice is the income. And frankly, it's the source of my income, of my increases in the account. And it's like I was at a restaurant the other day on a Greek island, and this boat pulled up and all these people got off of it. And as I watched these people come into the restaurant, I realized the restaurant owner needs the boat to unload the people because those are the people that are bringing in the outside money. And it's kind of like what we do as covered call sellers, right? We need the gamblers out there to be able to give us money, right? We sell them the option. That's the outside energy. And so that's kind of how I think about it. The stock can go up, down, or sideways. I can't control that. And if you think you know which direction a stock is going, I don't think you do. If you do, let me know and maybe we'll make some money together. But the way I make the money is because I don't know the stock, I try to get the juice. I guess I can layer in some probabilities and we try to predict, and I read lots of charts and I try to get a little edge in my favor. But the bottom line is I'm going to make money on the juice regardless. I like that. There's a 100% chance I make money on the juice. Now the stock can go up and down and I can't control that. So I can only control myself with how I play the juice. So let me explain to you the nuances of how this all works together in my system. First of all, most people don't, they buy in hope. They buy a stock and they hope it's going to go up, right? Well, I can tell you guys, hope is not a strategy for investing. You've got to have an edge. You know why? Because you're trading against everybody else that has an edge. All the big market makers on Wall Street, they got way more money than you do. They got lots of analysts. They have a slight edge, right? You're trading against those guys, right? You're not trading against Aunt Susie. You're trading against JP Morgan. Like, you think you're going to beat JP Morgan in their game when they got billions of dollars to wield? No, you've got to get an edge. So when I have a video out that says I make $10,000 in weekly juice, what do I mean by that? Well, I'm collecting the income, and the stock can go up, down, or sideways, and I'm always collecting the income. Does that mean at the end of the week I made $10,000 in net profit? Not always, because if the stock goes down, which is where the risk is for me, the account goes down, but I still got the $10,000 in juice, right? The money still comes in, the rent still comes in, whether the house goes up or down in value. So I'm collecting the income regardless of stock direction. So let me just drive that home. If the stock goes up, I get the juice. If the stock goes down, I get the juice. If the stock goes sideways, I get the juice. No matter what happens, I'm collecting the juice. The covered call is a bullish strategy, right? You want the stock to go up, and I'm going to show you all that in just a second. But the bottom line is if it goes down, that's where your risk is, right? So you want the stock to stay sideways or go slightly up. It's great. If it goes up way up, you'd use up a lot of working capital, as I explained in just a second. So the risk of covered calls is to the downside. All right, that's our baseline. Now let's start talking about a couple things here. First of all, if a stock goes down, it's the juice that keeps me in the game, right? I know stocks are going to go up and I know stocks are going to go down. I try not to get them when they're going down, but sometimes they do and I have no idea, right? It's the juice that keeps me in the game. So if a stock goes down, like I traded this MicroStrategy starting in November 20th, and I've got a big long playlist on the YouTube channel, and it says, that stock was at 477 when I started, and now the stock is at like 300 and something. And even though the stock is down, the account is still up because that outside energy came in and the juice kept me in the game, okay? The juice is the income that says, well, stocks go up and stocks go down, but it's gonna keep you in the game. Now, if the stock goes out of business, you're really screwed. So, we know that. We don't want the stock to go out of business. But here's Google, right? And if you look all the way here on the left side, in April of 2024, the stock was right around 175 bucks, right? And you can go 14 months all the way out to June of 2025, and the stock is, well, right around 175 bucks. So if you're one of those poor saps that just sat there and said, I'm going to buy some Google and I'm going to sit there and wait, you would have gotten all these ups and downs and headaches and, oh, I'm worried about it, and ooh, should I sell it, and all these emotional things. And look, it's a stock market. That's what you signed up for, right? But you wouldn't have made any money after 14 months, right? If you just held it and closed your eyes, after 14 months, you'd be even, okay? Now, let me show you an alternative way to look at that, because this is Google. It's not like it's some out of style stock or something. It's Google, like it's not going anywhere, right? But here it is, flat. Whether you agree with it or not, just go with the premise here. Now look at this. This is the option chain on Google. And if you're new to options, there's the call side and the put side. The call side is you want the stock to go up, and the put side, if you're the buyer, you want it to go down. We're not going to look at the put side right now. We're going to focus on this stuff. It's a little easier to understand. And the stock is at 178.22 as of the last close. And so now I've got these 180s, slightly out of the money, doesn't really matter, it's at the money, let's call it. And they're paying us $7.05 per share, or $705 per 100 shares per contract, okay? That's the juice, that's in the extrinsic column, okay? That's called the juice. So that's our income, $705 per contract. We own 1,000 contracts, we make $7,000 in juice. Simple, we make it no matter what, okay? So that's the analogy, that's the amount we're going to use. Well, that's about, if you do the math, that's about 1% a week. It's about 4% a month. $7.05 divided by $178.22 is about 4% a month. That's 48% a year. How you doing? How's that poor guy that just bought the Google doing on his Google? He's at zero. You're here at 48% if you can get 1% a week or 4% a month, like the $7.05 shows you. So there's a big advantage on being able to sell options against your stock, right? All right, so 48% a year in income. In the last 14 months, because this isn't just 12 months, it's 56% ROI versus zero holding the stock, just to drive that point in, okay? The income here is the key. And the stock is gonna go up and the stock's gonna go down, and you're gonna have to roll up over the strike price. But the juice is always coming in regardless of what happens. Every single week or every month, you're getting that 4%. Now, if you don't get whipsawed, you get to keep it all. And now we're going to work on what's the whipsaw, because this is a question that I get a lot, and it's a little bit harder to understand because it's a little esoteric. But I'm still going to try to get you a good explanation. What is it? What is the whipsaw? Well, it's having to use working capital to roll up over the strike price. That's not bad. That's a good thing, actually. But then capping your upside at a lower price if it drops back down, still not bad yet, unless the stock goes back up and then you have to do it again. Okay? That's what the whipsaw is. You're kind of just at the mercy of the market whipsawing you and using up some of your working capital. That's, got to tell you, it's a pain in the butt. You try to avoid this when you can. Now, what am I talking about? Well, you buy a stock at $100. You sell the $100 at the money calls, and you get $4. That's at 4% for the month, right? And the juice always declines to zero at expiration. Your time premium, your extrinsic value is always worth something now, but at expiration, it's always worth zero, okay? So assuming we just take this to expiration, you're gonna get the whole $4, okay? Now, what can happen? Well, let's say your stock stays at 100. I mean, that's the most likely scenario. The stock doesn't move. Well, I just showed you what happens over 14 months. It certainly can happen in a month. But you make $4. That's a 4% ROI. That's pretty good for the month, right? What if the stock drops? That's our risk. If the stock drops, you're down, from $98, which is your basis, because you got $100 minus the $2 that you got back. So now you're only in it for $98, and then the stock dropped $10. So you're down $8. Now, you would have been down $10 if you didn't have any call options. You would have been riding this thing up and down, kind of naked. But you're only down $8 in this case. So that's a slight benefit of having a covered call. or the stock goes up to 110. I don't care if it goes to 120, 150, 100 million, you're only going to make the $4. That's what you give up. You give up all that upside. Now, if you're one of those people that's like, oh, I should have not sold covered calls because then I wouldn't give up the upside. Well, you shouldn't be in covered calls if that's the way you're going to think. There's an income strategy, which is what I'm talking about, and then there's a capital gain strategy, which is what all the other people do. They sit there and they wait like a dope, hoping the stock goes up. And if it goes up, great, they were smart. But I just showed you Google over 14 months. Yeah, if you would have been able to day trade it and time it and all that kind of stuff, great. But we're not talking about that. We're talking about if you bought and held it for 14 months, you'd have made zero. But if the stock goes up, you end up making your maximum amount. Notice how the maximum amount is the same, whether the stock's at 100 or 110 or 150. Do the math yourself if you don't believe me. But the bottom line is you don't get the upside, right? You get the upside on your base, but definitely you lose the upside as it goes up against your working capital. Let me show you what I mean by that. All right. I've got these two little things that I've drawn on the screen. The top one is your short call options, and the bottom one is your base position. Don't forget, if you're doing the value every week and you want to know if you're up or down, you're going to need to figure out what the base position is. Don't forget about that. But I don't care about the base position after a while. I know I have the base position because I get to make the juice. And the base position is required for me to sell the juice. Otherwise, I'd be doing what are called naked calls, and I don't want to do those. So I own a base position. I own the stock, for example. Okay? Now, that basically moves in the same direction of the in-the-money amount on the short call options. So what does that mean? Well, when you short something and it goes up, it goes against you. So in the top here where it says it costs money over your strike, as it goes over your strike price, it's costing you working capital. What's that offset by? It's offset by the gains you're getting on the amount over your strike or the amount of the stock going up. Okay? So those offset. What are you left with? You're left with the juice. Okay? But let's say the stock goes up and then you roll up over your strike. Well, you're using up a little bit of working capital, but then it drops. Okay? Now you gain money when it drops to the extent that you have in the money amount. But if you're out of the money, you don't gain anything. You just drop it, right? And then it costs money on your drop on the base position. So those don't quite offset unless they're both in the money. That's why I like in the money calls, especially when the market's moving down or your stock is moving down. Okay? So that's the first two legs of the whipsaw, but you still haven't been hurt yet. Where you kind of get hurt now is if the stock stops going down and you capped your upside and now it goes back up over your strike price and you got to pull out more money in working capital and buy over your strike price. Now you could, of course, just let the whole thing go and forget about it and you've made your maximum profit. But I look at this as a long-term strategy, not like a weekly strategy. I look at it like I'm going to keep owning the stock for a long time. So rolling up doesn't bother me because my base position, as you see with these two parallel stock charts, is kind of doing the same thing. So that's where the whipsaw comes in. You pull money out of your account sitting in cash and you have to roll up and then it goes back down, you cap it, and then it goes back up over your strike price again. You got to roll up again. That costs you working capital. Make sense? If it doesn't, it will, right? Especially if you trade any of these. This is where the risk is in covered calls, is when you get whipsaws. You got a sideways moving stock and you keep rolling it up and rolling it down and rolling it up and rolling. You get whipsawed. You want your stock to trend higher. Trust me on that. That's why I like to buy stocks that are at the right spot on the chart and are trending higher. I'm happy that they go up. And as long as they don't keep coming back down, I'm good with that. Make sense? So I like to think of it as a whipsaw bucket. Like I've got a juice bucket. Now a juice bucket fills up every week. There's always a spigot filling that juice bucket every week, right? But I've got another bucket that I have to maintain, right? The whipsaw uses working capital, okay? It's not a loss, unless you want it to be. A lot of people think, oh, you're losing money over the strike price. Well, you're not. You're still getting the juice, and remember, you're gaining the base as it goes over your strike price, the same amount. So you're not losing money, but you are using working capital, for sure. And you are gaining in the money amount when the stock drops, and that offsets the working capital that you used, right? So that's the benefit of in the money covered calls, is that when stocks move down, that in the money amount moves in your favor, and that kind of fills your whipsaw bucket back up. So my goal is to try to kind of keep a mental track of how much I'm spending on rolling up and rolling down and all that stuff, and having a whipsaw bucket stay neutral, okay? Because that's where the big risk is this whipsaw bucket or the stock going out of business. Everything else I can handle. So if you get too many whipsaws, it chews up your working capital like I've just mentioned. And when you use working capital, it kind of raises the basis. If you bought a stock for $100 and you use up $5 of working capital to roll up and then it goes back down, well, you're in it at 105 now. So you've got to make that up. And you can make it up when it's in the money and it goes back down, that fills back up your working capital. And then you have your juice bucket over here making you money too. So you got to watch that whipsaw bucket, okay? Now, here is what you can do for that. It's best to try to keep track of your whipsaw bucket and keep it at zero or neutral, or however you want to look at it, and strategically use in the money and out of the money strategies to keep your bucket neutral and allow the juice to become your raw income. So what I like to tell people, it's really simplified, but in my system, we like to be in the money when the stocks are kind of moving sideways to down. And we like to be out of the money when stocks are moving kind of sideways to up, right? Most of the time, since we don't really know, right, we like to get our market green, our stock green, and then we have a probability that's moving up. Then when those stars align, which is not all the time, when they align, then you can be slightly out of the money if you want to. In the money, you could still make a good amount of money even if the stock is going up as well. So it's kind of a balance between in the money and out of the money. And I really like in the money trading because it gives you a cushion to the downside. All right? So listen, I hope that made sense. First of all, the juice is the income. The juice will set you free. If you focus on the juice and don't focus on all the other stuff, if you have a good stock and it's doing its thing, you can't control its movement, but you can control the juice. The juice will set you free. Secondly, keep an eye on your whipsaw bucket, right? Try to keep it neutral. Yeah, it's going to cost you some money to roll up, but if the stock keeps going up, that's fine because your base position is going up. But the problem is the other times when you have one of those stocks that's just going back and forth and not really doing much, that can cost you money in the short term. In the long term, you're still collecting the juice, but boy, is it frustrating to be whipsawed. I hope that clears up a few questions, and I'll see you next time. Bye. Let me ask you something. Are you tired of losing money in the stock market? Are you tired of watching your portfolio go nowhere while the markets swing up and down? Or maybe you handed your hard-earned money to a financial advisor, hoping they'd help you grow it, only to be disappointed by high fees and underwhelming returns? I get it. I've seen it all. And that's exactly why I created the Cash Flow Machine Elite course, to put the power back in your hands. This isn't just a theory. This is real, in-depth training on how to generate consistent weekly income from your existing portfolio using covered calls, just like the ones you see in my videos, but at a whole other level. Every week, you could be generating hundreds or even thousands of dollars in premium income, enough to easily pay for this course in a matter of weeks. And more importantly, enough to build a life where your money works for you and not the other way around. Let's be clear, this course isn't for everyone. It's not for people looking to get lucky. But if you got a decent sized portfolio and you're ready to stop hoping and start earning, then you owe it to yourself to invest in the knowledge that can change everything. The Elite course is now open. The results speak for themselves. Click on the link below and let's build your cash flow machine together. Hey, it's Mark Yagi, and if you haven't subscribed to this channel, please do that right now. That would be a great favor to me, and plus it helps me get this material out to a lot of other people that might need it. I've got a little bit of a movement going on here, and I want to try to change the world one person at a time, showing them that you can make safe, reliable income from the stock market. And plus it helps to grow the channel a little bit. Also, if you would give me a thumbs up on the video and like it, great. If you don't like it, give me a thumbs down, that's cool. But just tell me why you don't like it so I can get better. And then hit the notification bell so you can get these videos as soon as they come out, because a lot of times this is timely information and you want to get that information before it gets stale. The last thing is to join my free Insider Tips newsletter. There's a link below and you get everything in one spot. You get breaking news and analysis also. So that would be great if you could do that too. See you soon.